Mayuresh, what have you made of the fall that we've seen in Titan? Numbers look pretty good. They're continuing to grow at double digit despite a very high base. There is no outperformance to that extent, but still, the numbers are pretty healthy, but the stock has slipped 2%. What's the street concerned about apart from valuation?
Afternoon, Rima. No, I think as you rightly pointed out, I think the numbers that came in were in terms of expectations that were laid out by the street at the higher end. And obviously, like in the case of Bajaj Finance, though we've seen a reasonable AUM growth, for Titan's case, the resilience has been pretty strong. Specifically in its jewelry business, where on a year-on-year basis, you've seen 11% growth. On a consolidated basis, 12% growth. And even the watches segment has performed exceedingly well. So I think the expectations are more from both these stories at this point of time. And therefore, when you compare the kind of moves that the stock had given in the COVID era and what is expected specifically in the post-COVID era and the festive season that has just gone by in the previous quarter, much more was probably expected in terms of top-line stroke volume growth as well. The second element in terms of the structure of the company, I think great companies, no two ways about it. But the large element in terms of being still expensive at this point of time, where the street probably expects them to continue the growth that they have probably delivered on a quarter-on-quarter and a year-on-year basis at the same pace, that might just take the sheen off in terms of a slight bit of derating that can probably come through on the stocks. So I think the entire perspective is more price correction that is probably happening on the stocks at this point of time. The EPS rating specifically for a stock like Bajaj was out. For Titan, I think the gold jewelry business itself, the expectations of this very strong marriage season expected to take place is something which will hold true in terms of both volume growth and realization growth as well. But I think it's just the derating in terms of valuations and price correction that is happening. It's fear, Rima, Kalyan apparently is hitting 52-week size based on just this logic that valuations are seemingly more attractive at the broader end of the spectrum in the jewelry space.
Okay, all right. Mayuresh, just stay with us. 18,100 now, we're trading above those levels, which is good news from a bullish perspective. If we can end closer to the high point of the day, the bulls will take that with both hands. Just take a look at a couple of stocks. SBI has moved to the high point of the day from the banking names. UPL as well. It's a lightweight on the index, but that as well has moved up pretty well. But the reason that we're at the high point of the day yet again is because of a couple of those big winners. One is big boy, Reliance Industries. Just pull up the intraday chart out there. That's moved to the high point of the day. And HUL is the other darling in there from the bullish perspective. That one as well has moved up. I'm highlighting both these two because weightages are rather high on both these two names. Intraday chart tells you a better picture. Well, Mayuresh, we're just highlighting some of those big names. But I recall, y'all had come out with a note on the paper sector. And in 2022, well, the paper stocks did very, very well. What's your view right now? I'm looking at a couple of names. One of the highest traded volumes that I've seen in the recent past is on Orient paper, which was one of the biggest underperformers in 2022. Your view on the sector and if any take on Orient paper in particular?
Afternoon, Nigel. No, largely if you probably look at the construct of the paper industry itself, expected to grow at a 4-5% pace over the next couple of years. The unlock trade, which started 3 to 4 quarters before, has largely continued seemingly well, both in terms of volume and price growth. They have taken price hikes significantly because input cost pressure obviously had played out post the unlock trade as well. With businesses opening up, schools opening up, the expectations of this continuing augurs well for the sector as a whole. Around 23-24 in terms of the industry size in MMT terms, largely the large construct is packaging stroke, packaging paper as well and packaging board, which constitutes almost 60-odd%, followed by printing, writing and colored paper as well. Now, the large integrated companies, Nigel, will seemingly do well because in a scenario where input costs are coming off at this point of time, they are in better control, both in terms of raw material sourcing that they have because of their integrated capacities. At the same time, with the hikes that they've taken, even if they probably start cutting down prices a couple of quarters down the line, the margin improvement will still be stark. The third element obviously is going to help them is obviously, I think, the kind of expansions that are happening. I think very few expansions happening within this space itself, both brownfield and greenfield. And therefore, I think with the kind of e-commerce activity that we are probably seeing, packaging stroke packaging board is expected to grow significantly better in the coming few quarters as well. So I think integrated papers like the JK, West Coast, with capacities that they have at this point of time, and a better rating in terms of the overall business sense as well, and the model that they're probably running through can relatively seemingly do well. All paper companies, I just posted brilliant set of numbers in the previous quarter. So I think integrated companies.
Okay. The other set of stocks that I wanted to ask you about was the tire companies, Mayuresh, because, a lot of them have a dual positive. One, of course, crude and rubber prices have fallen to new lows. Then you have very good improvement in demand, especially in the SUV space. Any of these tire companies that you like from a long-term standpoint?
So, afternoon, Sonia. I think interesting positioning for the tire sector as well. Likewise, for the paper sector, input costs have gone down significantly. Whether you talk about natural rubber, synthetic rubber, natural nylon tire cord, and crude derivatives as well. So the kind of input cost inflation that they faced in the first couple of quarters in the first half should seemingly start coming off, and that should reflect very, very positively in terms of margins. The second element is also the product mix that they've got. So if in the case of Apollo Tyres as an example, the replacement market is pretty large. In the case of JK Tyres as an example, the CV portfolio is almost 55%, the PV portfolio 21%. I was just hearing out Nigel's piece at 2 o'clock when he was discussing Jamna as an ancillary in terms of a proxy play in terms of how CVs are expected to do well. Tires being a proxy for the CV space as well can continue doing well. The third element also, Sonia, is the anti-dumping duty, which had got extended till December 22. It might come out for review, and if probably that gets extended, the replacement market realizations, which are obviously far, far better, should hold out. And with the kind of OEM sales that you're probably looking at, the CV cycle holding strong, the PV cycle in very good stead at this point of time, volume growth should be reasonably strong as well. The sufficient amount of export opportunities that are also available because of higher costs for running these units in Europe, as an example, would also give an opportunity for these players. But more or less, domestic teams like a JK, CAT should continue doing well.